Welcome to the discussion of competitive advantage. This is part one, and I am Dr. J. Kent Gregory. So welcome to this presentation. It's based on chapter 5 of Frank Rothermel's Strategic Management, the 5th edition. So what we'll be talking about today are various ways to measure competitive advantage. So among the ways to do this is looking at the firm performance, and we can do that through accounting profitability, shareholder value creation, and economic value creation. There are also integrative frameworks that combine quantitative data with qualitative assessments, and these are the balanced scorecard and the triple bottom line. Well, accounting profitability, or profitability rather, this is, these are numbers, and so they're objective in ways, and they help us accurately assess a firm's performance. And it allows us to compare these numbers to the numbers of their competitors and the industry average. They're standardized and accepted accounting metrics. We can look at Form 10K statements, and we can look at various profitability ratios. The most popular of which is the return on invested capital, so ROIC. The return on invested capital, the formula for that are your net profits divided by the invested capital. So this is a good proxy for firm profitability because it measures how well a firm uses the capital that is invested in it to generate profits. An invested capital consists of two components. One would be shareholders' equity. So this is typically gained through selling ownership shares to the public. And then also interest-bearing debt, which a company can gain through borrowing from financial institutions as well as bondholders. The limitations of accounting data are that they're all historical, and as a result of that, accounting data is backward looking. So accounting data also does not consider off-balance sheet items such as pension obligations and leasing obligations, many of which can carry a pretty high price tag. And accounting data typically focus mainly on tangible assets, which, as we've discussed before, are no longer the most important or are no longer considered the most important. What are the most important are intangibles like innovation, quality, customer experience, intellectual property, talent, that kind of stuff. We can also judge a firm's performance through shareholder value creation. So the shareholders are those who own one or more shares of stock in a company. They're the legal owners. There's also risk capital. So this is money provided for an equity share in a company that cannot be recovered if the firm goes bankrupt. And then we can also look at total return to shareholders. This is the stock price appreciation plus dividends. And then there's also a way to look at it through market capitalization. This is the dollar value of total shares outstanding. And the way we arrive at this number is we take the number of outstanding shares and multiply that by the current share price. The limitations of shareholder value creation are a few. Stock prices can be highly volatile, as we all know. So as a result, it makes it difficult to truly and accurately assess firm performance, since it's subject to a number of unpredictable factors. Among these factors are the macroeconomic factors that affect stock prices, like economic growth or contraction, unemployment, interest and exchange rates. And then also stock prices can reflect the mood of investors. And investors, as we all know, can be very irrational. So that while shareholder value creation is valuable, is a valuable tool, I should say, we have to be cognizant of the fact that there are limitations to it. Well, thank you very much for listening to part one. I hope you enjoyed it, and stay tuned for part two.